I'm Pattu from Free FinCal. On this video, let's talk about how to start investing for retirement. A couple of videos ago, we looked at how to create your own retirement calculator to get a rough estimate of the corpus necessary, the target corpus, and the amount that you need to invest each month. So we will use that as a base, and we'll talk about how to make small steps towards investing for retirement. So the first step is, are your basics complete? So did you try out the retirement calculation, the DIY retirement calculation? Like I said, to get the rough estimates of the target corpus and the amount needed, check out that video if you have not done it. But that's the easy part. But after that, you must try to accumulate 6 months or at least 6 months of your monthly expenses in a separate bank account other than your salary account, if you have a salary. Or you can put it in a part of it in a liquid fund, part of it you can keep it in a separate SB account. That's your emergency fund. And if you are running EMIs, have an amount equal to 2 to 3 EMIs in addition to the 6 months monthly expenses. And you should also be contributing 5 to 10% of your take home pay to the above emergency fund. So this is the base of your financial plan. You must have a robust, solid emergency fund. You must also have life insurance. You must also have health insurance. These are the 3 basic pillars on which your wealth will be built. The secret to building wealth is not in returns. The secret to building wealth lies in 3 things. One is you start as early as possible. You give it maximum time to grow. Second, you invest as much as possible. And the third is where the emergency fund comes in. You do your best not to redeem from that invested money in case of emergencies. Sometimes the emergency may be too big that you cannot help it, but you do your best and you try as much as possible to avoid redeeming your investments. That is why you need a solid emergency fund in place. Only when this is in place, emergency fund, term insurance, that is life insurance, term life insurance, and a health insurance cover in addition to the company cover, then you can start building it. These 3 steps will take about 3 weeks at best to complete. Do that and then you can start investing. So if you don't have kids, then I would say you start investing in equity gradually. First you start slow, and then you build up the investment amount so that you are able to match your EPF contribution, assuming you have EPF. If you have NPS, then you can choose NPS to be 100% debt and then invest in equity separately. So let's say 5,000 rupees goes to your EPF contribution. Start slow, start with 500 rupees a month, start with 1,000 rupees a month in equity, and then build it up so that you are able to invest 5,000 rupees in equity over a period of few months. You do invest manually, don't start SIPs. Just put 500 rupees first a month for the first few months, then start putting 1,000 rupees, then and so on. Then that way you have a lot more flexibility. Then you can add 50% more than your EPF contribution. That is, if your EPF contribution is, let's say, 4,000 rupees, you add 150% of that. You invest 150% of that. That is, you invest 6,000 rupees in EPF. So that is 40%. So if out of the total money you have, you're going to invest, 40% should go to EPF and 60% should go to equity. That's the kind of asset allocation that you can start with initially. Build up gradually to that. There's no need to do it from day one. You can do that over a period of 6 months, even a year, even more, depending on how you are comfortable. So that's the point. So the point is to start slow, start small, but make a start, then keep building on that momentum. But where should I invest? My suggestion is, if you are new to equity, just choose one aggressive hybrid fund. Just one aggressive fund. Don't buy more than one fund. Just buy one fund. Treat that as pure equity, and that's enough. You may say, what about index funds? Yes, you can choose index funds also if you understand truly what index investing means, and you're not worried about downside protection, you're not worried about comparing with other funds. Then you can choose an index fund. You can choose initially a Nifty 50 index fund. That is fine. Down the line, when you're comfortable, you can add a little more of aggressive index funds like a Nifty Next 50. You can add a little more of that. Let's say 10 to 20% of Nifty Next 50 is fine, but that's up. So you can have two index funds. Or if you want an actively managed fund with guaranteed downside protection, then a single aggressive hybrid fund will get the job done for you. If you do have kids, then most likely what will happen is the amount you can invest towards retirement or towards any single goal, that is their education, would be less. So the best way is to not worry too much about goal planning calculators. I have to do a video on how to plan for your children's future needs. I'll do that separately. But my suggestion is don't worry too much about those results. Let us say you can invest a total of 18,000 rupees a month, right? This is separate in addition to the EPF contribution. Divided into 2 if you have 1 kid, divided into 3 if you have 2 kids. So if, let's say if you have 2 kids, then divided into 3 portions, 6,000, 6,000, 6,000. 6,000 rupees you invest in equity for retirement. 12,000 rupees you are going to invest totally for 2 kids, and we will see how to invest that. If you have one child, then you can invest 9,000 rupees for retirement and 9,000 rupees for that 1 kid. Of course, you may argue which is more important, investing for kids' education or investing for retirement is more important and so on. It's very debatable. My suggestion is that you start equally on both fronts. Then once you're comfortable, you can decide as you wish. Eventually, you'll have to invest more for retirement, but starting equally is fine. That's it will give you that some psychological benefit. Again, invest where just aggressive hybrid funds will do. If you want to know which aggressive hybrid funds, you can either use my Plumbline, my handpicked funds, or you can use my monthly screener to pick the aggressive hybrid funds. All the links are in the description box. You can either choose 2 funds, 1 fund for retirement, 1 fund for both your kids or a single kid, or you can put everything in a single fund. That's also fine. It depends on how you want to play. Personally, I keep things separate because they are mutual funds and its units are first in, first out. Redemption and asset rebalancing and risk management becomes a little messy if you put everything in a single fund, because retirement is 20 years away, your children's needs are 10 years away. It's kind of messy, so I like to keep things separate, but it is possible to use a single fund. There's one more advantage, I'll talk about that. So how do you invest? If you have, so I'm assuming that you have EPF or NPS, so then you invest that amount I just mentioned in for retirement in an aggressive hybrid fund. For your kid or kids, you can choose a PPF if there are 15 financial years away between now and before they finish school. Then you can choose PPF. You can put 40 to 50% in PPF and the rest in aggressive hybrid fund. If PPF is not eligible, that is your child is, let's say 6-7 years old, then PPF is not possible because it will not mature before he or she finishes school. Then don't overthink it. Just use a simple liquid fund. You will sleep peacefully at night. Don't worry too much about it. Then you can use, like I said, you can use the same aggressive hybrid fund for all the goals. There is kids as well and retirement, or you can have separate ones. I prefer separate ones. But if you use the same instruments, I have a calculator called Unified Portfolio Calculator. That's also linked below. Then the initial amount you need to invest for all the goals, that is, if you combine all your long-term goals as one, then the initial investment amount becomes lower. So it may be psychologically more beneficial to use that as well. So you can try using that calculator and see if you can make that investment amount. So that's it. So keep it simple. Don't buy too many products. Start with one fund, and that's all most of us need. Unless we are investing like lakhs and lakhs every month, I think one fund is enough for most of us. Make a start. It's very important to make a start. Don't get bogged down. Oh, the retirement calculator is saying, no, I need so many crores, I won't be able to invest this much. Don't keep giving excuses. Make a start. It's like an exercise. You have to do it regularly. Keep a log of how much you invest each month. Keep track of your investments. Tracking expenses is a waste of time. It doesn't help you. It's not a productive activity. It will not make you rich. increase your investments 5 to 10% each year. I have an Excel sheet. I just entered this month's March investments there. I have been using the same Excel sheet from 2011 continuously, and touch wood, I have been increasing my investments, try to increase my investments every year by 10%, and it gives me a sense of accomplishment when I do that. That's what's important. It doesn't matter what my returns are. I focus on your investments. Focus on increasing that. Focus on the rate at which your investments grow, not your invested amount. So make a start. Then you can learn about asset allocation, risk management, and tactical asset allocation. All that you can do. But first, make a start. Then gradually you pay more attention to the results of the calculation. You can use my robot advisory template. Then you try to increase gradually the investment amount so that you match the what the calculation tells you, what the asset allocation, what the robot template tells you, and so on. But make a start. That's what's more important. Don't get bogged down on what is the best way to invest. What is the best strategy? What is the best fund? People keep waste a lot of time in all this. I still don't know what is the best fund, and I don't care. Make a beginning. That's what's more important. So I love this quote by Vincent Van Gogh. Great things are not done by impulse, but by a series of small things brought together. And great things are not accidental, but must certainly be willed. So if you want to achieve greatness, whether in life or in terms of money, I keep saying this again and again. If you want to be a multi-crorepati, you have to take one step forward. Do the small things right, do them consistently, and have the faith that you will. You must believe that you can, and then that's the first step. You must, with that belief, you keep working consistently, and then hopefully, if you're lucky and things turn out, you might do well. Even if you reach half the journey, that's something. That is that's a great achievement. So don't worry too much about all this. Of course, risk is important. There is no you can't expect returns from equity and all that, but you must still believe that I will invest in a portfolio with a proper diversification, and I will manage my risk, and I will invest enough and do goal-based risk management to achieve my goal. That belief is very important. Only then you learn more about it and work towards it. So that's more important than saying I'm expecting 10% from equity, 15% from equity. That's just nonsense. So that's what I wanted to say. Check out the links in the description box. Thank you for listening, and let me know questions that you have in this about retirement or about investing for child's education. I'll try to make more videos. If you what are your other real problems that you face, let me know what they are, and I will try to work on them. So I'll catch you again later. Bye bye.